All right, how's it going, everybody? We're here for our November edition of the Investment Committee webinar. So today we want to give you guys a market update, talk about some of the recent news stories that we've seen over the last month, and we have some interesting charts and graphs. So before getting into the numbers, I want to just give a quick overview of some of the headlines that have really shaped the market over the last month and will continue to be important to monitor moving forward before we really dive into those numbers. So the government right now is coming off of a 43-day shutdown. There's some fears around AI optimism being too strong and concerns around valuation. And there's also the chances of a rate cut have come down pretty dramatically for December. So we'll see that and dive into those stories a bit more later on in the webinar. Looking so far at 2025 year to date for the S&P 500, up about 16%. And if we look at some of the other major indices in the last month, some numbers that really pop off the page, the Russell 2000, which is that small cap index, is down about 3% in the last month. International stocks continue to be strong with the best performance out of those major indices in the last month at 2.3%. And the S&P, NASDAQ, and Dow all in the middle there between 1% and 2% over the last 1 month. Brandon, what are we seeing in terms of some of the individual sectors' performance over the last month?
Yeah, I think when you look at the sector performance table, the big takeaway is the healthcare sector. In the last month, it's up about 7.6%. And if we go back to last webinar, during that, last 1 month period, it was up about 6%. So you're starting to see, multiple months in a row, where it's performing well if you go 6% and then 7.6%. And if you actually look at, the healthcare sector, Eli Lilly's the, biggest holding there with 15%. And over the last month, that's up about 28%. So that's one of the driving factors that you're seeing of, why that healthcare is starting to, outperform. And even year to date, you can see that starting to catch up, being up about 12.5%, even though it's still lagging, the technology sector and communication sector from a year to date perspective.
Yep. Yeah, and you could see that fear of the AI optimism being too strong when you're looking at that communication sector, technology sector. Those have lagged a little bit over the last 1 month. And I always want to keep you guys up to date on what we're seeing in terms of money market rates with the recent rate cut. That's now down to 3.7%. So if we continue to see the Fed cut rates, that money market rate will move hand in hand with that.
A little shocking to see the energy sector up so much year to date, given the fact that oil started the year around $72 and is currently right around 60.
Yeah, definitely. Looking at the 10-year Treasury rate, that's about 4.1% right now. And as we mentioned at the start, big story here is looking forward to December's Fed meeting. There's a 57% chance now, or about 60%, that there's not going to be a cut in December, where when we were sitting here a month ago from today, that number was 90% chance of a cut happening. So been a pretty big shift in terms of the expectations surrounding the Fed cutting rates or not cutting rates. If we look forward to 2026, there's still 75 basis points priced in to the market right now of cuts for 2026. So that has been a major shift, and we'll get into some of the reasons around why that shift has happened. But that has also played a big part in why we've seen somewhat of a dip over the last week or two, is that change in expectations surrounding what the Fed's going to do with interest rates.
Yeah, I think one thing to point out there, Sean, is just how quickly that change happened. So on our last monthly call, we kind of raised a little bit of skepticism over how many cuts the market was predicting over the next, call it 9 months. We thought that they were going to have to kind of go back and maybe revise those numbers down. I did not think any of us thought that it was going to be revised down so significantly in 1 month's time for December, and they still haven't revised down any of the numbers really for 2026, which is also likely, potentially likely, let me say, to happen. So a lot of optimism on how the Fed was going to be cutting rates. That optimism is slowly being met with reality. Some of the comments the Fed governors are talking about some of the policy comments that have been made by FOMC committee members, and kind of this realization that they are going to kind of keep to their process. Whereas I think there was a little optimism that the administration was going to have a little bit more influence on how quickly rates were cut. So we'll see how that evolves, but it's interesting how quickly that change happened, 90% to 40%, and really not that much other than a government shutdown and a little bit of data trickle.
Yep. Yeah. Even if you look at, the beginning of last week when we started, putting stuff together in the data for the webinar, it was still at around, a 60% chance that they would have a 25 basis point cut. And even just as the week went on and coming in this morning, it's obviously, the probability increased that they actually won't cut.
Mm. Yeah, this also is evidence of how quickly markets just change their mind, that there's absolutely nothing written in stone for any market participant. They are happy to change on the drop of a dime, or one analyst report, or one comment, which is why it sometimes can be frustrating for market participants who aren't watching it very closely. But for those who watch it closely, just kind of realize there's a lot of noise, and a lot of big shifts that can happen in short periods of time over seemingly nothing.
Yep. And one of the things the Fed always says, they're going to remain data dependent. I think one of the issues and one of the reasons we've seen this decline in the chance of a rate cut is that government shutdown. So government was shut down for 43 days, which was the longest shutdown we've ever had. And that means that economic data was missed throughout that month. We did get CPI release, but it was delayed. But looking at things like labor statistics, GDP estimates, there was not as much of that economic data coming out because it wasn't being collected during the government shutdown. And not having that data gives pause to the Fed to continue cutting rates when they don't have those data points to really rely on. So I think this is one of those factors that definitely played a part in that reduction of chance for a rate cut. CPI is still at 3%. So it's above that long-term target, as we've talked about in the past, of 2% for the Fed. GDP estimates, earnings have been extremely strong. So if we look over the last 4 consecutive quarters, we've had double-digit earnings growth in each of those 4 quarters. And even looking forward to 2026, that's going to continue to be the consensus looking forward, at least for now. And we've also had some tariff news recently, with tariffs being rolled back on some food products like beef, coffee, bananas. So last Thursday, those tariffs were rolled back to try to ease some of the pressure that's on inflation and on the American consumer. So those are some of the factors that have gone into that Fed decision that's coming up in December.
That rollback is an admission that tariffs are inflationary.
Yeah.
Sorry, Brando, what were you gonna say?
No, no. Yeah, and I think just from the data perspective of, the government being open again now, but how when that data comes out compared to when the Fed meeting is, of how much time they actually have to, review it and analyze it before going into that meeting. And same, if anything continues to get delayed coming out, by the end of this year or the beginning of next year.
Yep.
Yes. So on this chart, a lot of the news and headlines are, there's an AI bubble. There might be a decline. Really, but just putting some data and context around that instead of just, looking at the headlines. So the chart to the right is the tech sector PE, or the price to earnings ratio, which is really a traditional valuation metric. And, it's going back from 1996 up until now. And really, the big takeaway that we're looking at here is if you're looking at the dot-com bubble, that PE was around 70, and currently it's around 40. So you can kind of draw a, median line, right around 30-ish. And that kind of brings out 2 points of just what to look at. Are things overvalued? Are they undervalued? Is there an opportunity somewhere? And really taking into, consideration the historical context of, where we are versus where it was during the dot-com bubble, as you hear that comparison a lot of, what might be coming down in the future. Oh, there might be a large decline. But, putting some data around it and not just looking at the headlines, I think is an important outlook and just taking a step back to realize where actually are we in the market, not just, hey, there's a bubble.
Yeah. I think one of the other things that we were talking about with respect to this chart and just kind of some of the realities, there is a period of time there between 2001, call it, and really 2015 is when the tech sector started taking off. And that period has right before the financial crisis, let's call it around 25 to 27 as the PE range. Then it dropped as the financial crisis kind of took hold and all prices came down. So we saw the PE ratio come down. And then we saw, things kind of come back. But those we would call buying opportunities when the tech sector is below 20. It doesn't stay there for very long. That has led to outsized returns. If you were investing during that period, you did very, very well looking forward. When you're buying at a level higher than 40, let's call it, that has usually led to lower rates of return. And that's really how to think about this is where you buy is going to dictate what your level of return is. If you're buying at a higher point in this chart, you should expect returns to be relatively lower. It's not necessarily concern over a crash as much as you just have to anticipate lower returns. And if you're buying at a lower PE ratio, you normally can anticipate higher rates of return. So we're kind of at a point where we're a little above trend, but with 15% earnings growth or even plus, what that means is you might capture that earnings growth, but then you might see slight decline in what the average price paid for, which as Brandon said, maybe 30, 35, maybe even 25 if you want to be more bearish. And that's just going to erode some of your potential returns in this space, which is why you have to always be careful about the price you pay, but also cognizant of where we are with respect to historical norms and what the future opportunities are. I mean, all of this ends up being a very complicated mix of things, which is why this stuff isn't easy. But I think the biggest picture is declines of 20% or 30% from this level of 40 times, even if nothing happens to earnings, kind of takes us back to a normal place. 20 to 30% decline here, which is what we think people should anticipate when investing in the tech sector. It's kind of what's built in. That can happen, and that would only take us back to historic levels. That is not representative of a bubble. That's just representative of market normalizing. So we've seen a 5% decline in the past few weeks. We could see more of a decline at any point in time for really no other reason than just cyclical or sentiment shifts in investors thinking. So that's something that is not indicative of a bubble. That's indicative of a cycle. And cycles, thankfully, are shorter nowadays, or so we're seeing in the evidence. They tend to be sharper dips with quicker recoveries. But that just means you have to be more nimble, a little bit more open-minded, and a little bit more thoughtful about where we are in any given cycle, and then how to invest looking forward. And that's just something you need to build into your strategy, which is something we take very seriously here.
Yeah, definitely. And I think it's so important to look at these valuation metrics like PE versus just looking at the market and seeing we were up 20% plus in 2023, looking at the S&P, up another 20% plus in 2024, 15% plus here in 2025. Just looking at those numbers and a chart of the S&P 500, you might think we're definitely in a bubble. How could we not be? Once you start to take into effect or account some of these other factors like double-digit earnings growth over the last 4 consecutive quarters, and really looking at it from a valuation standpoint, it hasn't just been expansion of multiples. There's been a lot of profitability in the tech sector, and it doesn't look as bubbly or scary when you look at something like this PE chart here, especially when you're comparing it to something like that dot-com bubble in 2001, where a lot of the tech sector companies were not even profitable at that point. So I think it's just good to take that context into consideration as opposed to just looking at a chart of the S&P. Adding that overlay of the valuation metrics can be an important addition there.
Yeah, and then here on this slide, last slide we obviously had the tech sector. Here we just have specific companies. So we have Microsoft, Disney, and Oracle. And, it's showing a similar picture where in 2000, you have that PE high. For Microsoft, it was 73. For Disney, it was around 130, and then a high of 700 in 2001. And then even Oracle had a, high PE of 127. But if you're looking at, the table at the bottom of the median and current PE, they're much more in line than that high, especially if you're looking at Microsoft. It's only right above the median. Even where, Oracle is, 19 above the median, it's still not anywhere near where, that high might be, or where the high was, and where, people might think it is based off of, the performance, whether it's this year or the past couple of years, and just where the market is generally today. And then going to, whether something's above or below that median line, kind of Jordan mentioned it on the last slide of, is there an opportunity based off of, where it is today based on this? And in the Microsoft chart, you can kind of see that from 2005 to 2015, where it's below that median line. And then obviously, today it's a little bit above where that median is right now.
Yeah, and just to put into context, Microsoft's earnings have grown, somewhere around 15% during that period of time. But because its multiples gone up, the annualized return since 2015 for Microsoft is right around 26%. If you roll it back a couple years when the price to earnings is even lower, it's even higher than that. So that goes back to that point. More uh, the more you factor in valuation and capture good values versus bad values, your potential return goes up. And so as we look at now, it's really not significantly. And Microsoft is a company that's right in the heart of AI. So is Oracle. These are both companies that you see participating very strongly in strong AI stories. They're both involved with OpenAI, one of the leaders, if you will, the owner of ChatGPT. So these are good reflective companies of where the bubble around AI kind of stands versus the bubble of the internet and technology back in those 90s and 2000s. And both Microsoft and Oracle were strong, very profitable back then, whereas many of the companies weren't. So these are kind of the best of breed of that period of time, which have survived the next 25 years and have done it rather elegantly. And as you can see, the multiples that they were trading at in that period was significantly higher. And I think the sustainability of these companies, when investors look at these companies, they almost look at them as the blue chip stalwarts of the market, where in the 1990s they were still young and unproven companies through major cyclical changes. And so that's kind of changed that view. We threw Disney on there as well, and Disney really is more like 130. Its earnings went down significantly when after 9/11, and there was a big shift in Americans' uh, openness to travel, and a lot of bookings were canceled. But if you look at that versus this, it's really more an example of how companies, once everyone gets loaded up into one sector, people start to look for other sectors and companies that are performing very well. And Disney's one of those that has kind of always had great brand, great IP, just an incredible performer. And it's now trading at about 16 times. And Disney's, which trading a little above 100 right now, it was as high as 200 if we go back when Disney Plus was launched, and there was a lot of optimism around how they were going to do with streaming. And now the company is really trading at a lower level. So this is also a good example of how, even though the market is relatively high, even some great blue chip style companies are trading at relatively attractive levels. Even companies that got caught up in previous buying frenzies like the tech bubble. So I think we tried to put a lot in this one slide because we felt like there was a lot of story here when you lift the hood and look under at the engine and what's really driving the market. And it's really high earnings from some of these great performing companies. There's also a lot of value still out there in companies which have great stories. And then there's a couple companies which are a little overvalued and trading on a lot of unicorns and pixie dust. And those are companies you just have to be careful of and either have a really effective strategy or maybe choose to avoid because you don't want to ride the bucking bronco. So these are all just things to factor in as you build this cohesive strategy around how to invest and earn long-term returns.
Yep. Yeah, and you mentioned Oracle. I mean, that rose 25% on the Open AI deal in September and since has fallen all the way back to where it was previous. So I think there's also some fatigue around like the Open AI deals. They've had deals with AMD, Nvidia, Broadcom. As you mentioned, Microsoft has a 10% stake. and they're all like multi-billion-dollar deals. So I think there's been some fatigue around the amount of deals, and there's a desire to see some of that start to play out before people just let those headlines of deals really impact buying behavior. Because to a certain extent, you can only trade so much on just potential future deals, which that's been interesting.
And overall, it's an exciting market right now. You've got money market rates are coming down. People are going to want to put money in different places, but they're still relatively high. Interest rates are still relatively attractive compared to the last 15 years at least. So there's a lot of places to make money. There's a lot of different ways to construct a portfolio to get a good, possible return out of your portfolio. I think, where most people kind of wake up and hope to achieve, there's a lot of different ways to do that and ways to avoid some of the risks and concerns that you might have if, an AI bubble, even if these charts don't tell you something that helps you feel a little bit more constructive about that opportunity. There are other ways to earn a lot of return. And that's one of the things that I think we take very seriously here and that we think about. So, whether you're a client or someone who's just listening to this and wondering what are some of those other ideas, we love having those conversations. That's what we're all about talking about. But at the same time, I think if you want to earn outsized parts, you know, aspects of return, if you want to be in what may be the biggest story in the next 10 years, which is AI, how do you constructively approach that and deal with the fact that there's going to be volatility in it because so much is built on future expectations? And as we saw with even something as simple as the next Fed meeting and the possibility of a rate cut, it went from 90% to 40% in 1 month. And that was with not a lot of information data. That's just investors, changing their mind and reflecting that change. And that's going to happen with the AI story as well. As headlines come out, as different comments are interpreted by CEOs, you're just going to see big changes in how investors perceive what that opportunity set is. And that makes it more challenging to, hang on and keep a consistent long-term view. And that's something, again, how do you construct the portfolio? How do you, manage your exposure? These are all things which it's not always easy. And that's why, we're here to help and give some guidance there on how to do it in a way where you can be comfortable and know that you're going to achieve your goals.
Absolutely. That's all we got, guys.
All right, awesome. Well, everyone have a great holiday with Thanksgiving. Hopefully everyone gets to spend some good time with their family and stay warm out there. It's gotten a lot colder and a lot windier, kind of across the board. So hopefully everyone's looking forward to the holiday season. We'll see you guys in December.
Yep. Happy Thanksgiving, everyone. Take care.